All right, what's up, party people? My name is Sunny Ray. This is the Sunny Ray Show. Today, I'm really excited. I'm with Jesse Cole. Jesse, where are you calling in from?
I am calling in from East Hampton, New York, a little suburb outside of New York City. Most people know the Hamptons as, the mecca of the party, the East Coast party center, but one of the most beautiful places in the country, in my opinion.
Yes, I was actually just telling my wife I gotta take the little ones. We gotta still make our trip to New York, and they're excited. So you were born and raised in New York. What part of growing up in the city shaped how you operate today? And actually, before we even dive into that, actually, what can you give us maybe a paragraph or two on Synthesis Ventures? Like, what's your kind of high level thesis there? And
Sure.
we'll keep it short,
Synthesis,
but I want to come back to it and spend some time on it later.
Synthesis is my second fund. The first fund was called the Seed Lab, which was a little bit more consumer focused. We started the Seed Lab in the beginning in 2019, raised most of our capital pre-COVID and probably right on the fringe of COVID. And then we paused. We had no idea how the world was going to shake out, how accessible founders were going to be, what the demand for some of our product offerings were going to look like and so forth. So we paused, deployed all that capital within an 18-month period. And then 2 years ago, I started a second fund, Synthesis Ventures, backed by one of the wealthiest families out of Turkey, one of the original founders of Tether, one other very notable investor. I brought two partners in, and my partners are incredibly disciplined. And our core thesis is really looking at companies, more or less in the B2B space, software, things making a difference with the integration or upgrade of technology, making these marketplaces, making these sort of verticals, a little bit more in line with reality and today's, more or less today's, world. So we look at antiquated industry with an upgrade of technology. Now they're in the mainstream. But we're always looking for really, really interesting ideas. And I would say our sort of core central thesis, finding companies that are really having somewhat of societal good that meets capital prospect. We want to make money, but we really want to find companies that are doing really good things for the planet, but more so for people who live here.
Amazing, amazing. Yeah, big fan of Tether. As I mentioned, I've been in the crypto scene for a long time, and amazing. Okay, so I love that thesis. So, like I said, you were born and raised in New York. I was wondering, what part of like in terms of growing up in the city, how did it shape how you operate today? More than perhaps people give the city credit for.
Well, look, I was a child of the 80s, so I'm assuming that most of your listeners and most of your audience are a lot younger than I am. But growing up in New York City in the 80s, it was the Wild West, right? We didn't have access to technology. I remember when, my father first came home with our first answering machine. And this was a way for us, to communicate when we were out. We would ask our parents, don't pick up the phone from 9 o'clock onwards, because we would call in and we would check our messages and our friends would leave, their sort of coordinates on the machine. But growing up in New York City in the 80s, early 90s was an incredible experience. I still maintain some of the friendships that I made when I was a kid. But it really, really, required you to think fast, think on your feet, right? It was a different place. It was a bit gritty. It was a bit dirty. It was a bit naughty, which I liked. Um, but the relationships were paramount to anything else. And while other people were enjoying green grass in the suburbs, I was enjoying cement and taxi cabs and trying to get myself into bars at a very, very young age.
And then you went to Cornell and picked sociology, right? Not
I
finance.
did. I went to Cornell. I was a lacrosse player in Cornell. I was a sociology major at Cornell. And I think one of the biggest lessons that I learned was, my father dropped me off, and he said to me, Jesse, it's remarkable as an underachiever that you are at Cornell. Uh, but let me give you some advice. And he had never really given me much advice, even though he was a disciplinarian. He said, if you're ever the smartest guy in any room at Cornell, please get the fuck out. And pardon my French. And that really was sort of a lesson because I was not going to be the smartest guy in any room at Cornell. There was a lot of smart people, a lot of really well educated people, a lot of really wise people. But it really occurred to me that, living life as an island, is fairly impossible, and bringing people in and around your orbit, to help, develop, establish, to critical think, and so forth, was a big lesson for me. And I'm a big believer that four eyes on any project is better than any two. You put two people, three people, four people in a room together, right? It's going to yield positive results, right? If you can collectively work together, learn how to manage each other's times and thought processes and so forth. And so I'm a big believer in the team.
And then straight from Cornell into equity research sales at ISI Group. So what pulled you to the sell side instead of, say, an operating role at a startup?
Well, the world was different then. When I graduated from college, I didn't want to be, in the world of finance, but there were very few industries for people like myself to go into. We had finance, you had, marketing was a big, sort of vertical. There were a variety of verticals, but I didn't want to be a lawyer. I didn't want to be a doctor, right? And so finance was really where most people from, you know, our university gravitated towards and so forth. And it was a big deal to have a position on Wall Street. And so, I wanted to be an agent. I wanted to spend my life being a talent manager, working on deals. But coming from New York, it was very, very difficult to break into the Hollywood scene. It had been very nepotistic. They recruited, some people, from in and around their area. And it was very rare that someone from the East Coast wanted to enter into that fray. And so, after my first couple of years on Wall Street, I went back to Columbia for grad school as a way for me to pivot. I wasn't quite sure what I wanted to do or how I was going to get there. All I knew is I didn't want to spend a majority of my career working on Wall Street. And so I went back to Columbia, spent a couple of years, in grad school, and Ed Hyman from ISI Group, who's now the chairman of Evercore ISI, he recruited me, and that started a 17-year career.
And then you picked up a master's at Columbia in '99 as well, right? So right at the peak of kind of like the dot-com
I
mania.
did. I mean, it was quite remarkable. You had a lot of people, that traditionally would have went the Wall Street route or the finance route, and a good percentage or a good majority of my class were taking these leaps into, the dot-com era or the dot-com startup world, and it was a risk. But it was that wild west where people were, interested in pursuing something other than the traditional, the traditional, course of action per se.
And then you co-founded a boutique investment platform and built it to an acquisition by Merlin in 2009, right after the financial crisis, right? So what did selling into that market teach you about timing that you couldn't have, learned in a calm market?
Well, when I started that platform, I had been working for a different company, and you were required to pay or give 50% of your profits, to the house. And that's pretty traditional, right? And I was just tired of doing so. And so I knew that I can go ahead and start my own platform. I was younger, of course, and so I found a billionaire by the name of Steven Schoenfeld, who's one of the notorious investors, Wall Street kingpins out there. And he backed a broker dealer that we together created. And he really gave me the infrastructure, and support to do so. And we built it. We built it successfully. And 3 years later, we managed to secure a deal with Merlin, which was a Sequoia-backed business off the West Coast, where they sort of inherited our platform. And I joined that platform as a senior partner. It had a much bigger infrastructure, a much different sort of mentality. We were a startup coming from Schoenfeld. We were a bunch of gritty guys that hustled each and every day, and we were very successful doing it. But then when we were absorbed by Merlin, it was a much more institutional platform. It was much more buttoned up. Your uniform had to be different, right? The rules and regulations seemed to be a bit different. The clients seemed to be a bit bigger. So it took a bit of an adjustment, but it was nice to be, part of a much larger team, and we sold that platform 3 years later. So there was essentially two exits in 6 years.
I'm gonna ask you, so to Wells Fargo for 315 million in 2012. From the inside, what does the transition from boutique to bank owned do to a team?
Well, a lot of the guys that I had recruited to work on my platform, these were salt to the earth guys. These were hustlers. These were guys who came to work every day. They showed up every day, and they just wanted to make money. They wanted to do good, hard work and make money. Some of these guys just didn't have the legacy. They didn't have the college educations. They didn't have the look per se that a larger bank or a larger institution would have accepted per se. And so I like giving everyone a chance. I think if you're a hard worker and you're honest and you're a good teammate, I think that's a great, ingredient for something really, really, really positive. And so when we were acquired, by Merlin, a lot of the guys were not absorbed in that merger per se. And so, a lot of these guys had to go find other jobs. And in the beginning, I really didn't want to discontinue or disqualify any of these guys, because they had been working in and around me for 3 years. But it was also a numbers game, right? They can only absorb so many people. They only had, a certain budget to bring certain people on. So like any other, M&A transaction, there's going to be some cost cutting at the top to preserve the bottom.
Hmm, interesting. And then after 17 years on Wall Street, you stepped sideways into fashion, right? As CEO of a company with your wife as the creative engine. So that's a pivot, most people would not survive professionally. Like, walk me through that decision. Like, how did you
Well,
rise to that?
after the deal with Wells Fargo in 2012, I had been married at the time, and my wife, she had been one of the founders of a clothing company called Theory with Andrew Rosen, and they had sold that company to the Japanese. And my wife at the time, she had been traveling over to Europe. She had a big, institutional fashion apparel job, and she was brought over to help operationally, and she hated it. She just didn't want to do it. She wanted to be more creative. And so, she came home from Europe and said, I've got to do something for myself. I really don't want to be working in such a big conglomerate. And I said, well, then, frankly, you're unemployable because the world knows you as an operator, does not know you as a creator. And so we started a business, started, pardon me, out of the apartment, and that business grew, like a weed, And when we sold Merlin to Wells Fargo, that's when I sort of stepped in as the chairman, CEO of the company. At the time, the company was doing roughly around 15, 16, 17 million in top line. And that was 2012. By 2017, we were doing somewhere north of 35, 40 million. But I will tell you, working with a spouse, working in apparel, right? Working in women's contemporary, where we ship 12, 13, 14 times a year. And also at the time, we were a big wholesale business. We were entering into the retail category as well. This was sort of the introduction to the direct channel. So I'll put all three or four of those things in a pot. It's a recipe for disaster.
What's Hot Hippie?
So Haute Hippie was the clothing company. It was a
That
women's
was the
women's
one.
women's contemporary clothing company. Uh,
Got
the,
it.
the company had started in 2009. I joined as the CEO chairman in 2012. We sold the company to private equity in 2017.
Got
But I
it.
will tell you, Sonny, it is not for the faint of heart. Right? The apparel world, what people don't understand is that to get from a sketch to a rack, it takes an army, and you are manufacturing overseas. You have probably 9, 10, 11 different verticals that really need to run in tandem or run in sync with one another to get these clothes from conception, from a sketch onto a rack. And it doesn't end there, right? If the clothes don't sell and there isn't sell through on the clothing, right, then there's a markdown cadence, right? Then there's another markdown cadence. Then we have to find a home for these clothes in order to sell off price. And if they don't sell, what happens to the clothes? And so the longer it goes, the more it impacts your margin. The more it impacts your margin, the more it affects your your bottom line. And so a very, very, very challenging business. But I learned a lot of lessons working in and around that company as the CEO. Um, it was a very, very difficult time for us, and I can get into some of those lessons at a later time. But it's not for the faint of heart. And when you are financially insecure, like you always are running an apparel business, you just can't always afford top talent. So you're hiring younger. You're hiring younger to do the job that a couple of people should be doing, that could take 3, 4, 5 times the amount of people that senior people could be doing. So very, very challenging.
And then you could have gone back to finance after the exit. Instead, you co-founded the Seed Lab with Danny Levy and George Hornig. So why early stage, and why not like a comfortable corporate seat?
Well, after we had sold Haute Hippie in 2017, I started to invest some personal capital into sort of the consumer vertical. And I found myself sort of making some mistakes. I was having a difficult time underwriting some of these assets. I was finding some of these assets through the intersection of traditional media, and new media, sort of call it non-traditional media at the time, like Instagram and other social platforms. And a lot of these companies were getting a lot more exposure than they truly deserved. And I was writing checks, personal checks, and it finally occurred to me. I said, it's very, very difficult to distinguish, a fad from a trend to a sustainable business into a monetizable asset. And I learned a very, very big lesson back in 2000, call it 15, 16, 17, where I was looking at Airbnb as an early investor. And one of the world's best investors, who's no longer with us, who was very interested in purchasing our apparel company, which gave me close proximity to him, he had said to me, don't look at a startup, don't look at a company for face value. That's what they want you to see. Look at it from the lens of the founder. And so, looking at Airbnb, when I first saw it, I said, this is the craziest idea I've ever seen. You're going to rent your home out. You're going to have people sleeping in your master bedroom, showering in your bathroom, eating off of your utensils. And whether or not you rent your place for 1 day or for 2 weeks, it's the same amount of work to prepare your home. And most people, They don't treat your home as well as you do. So you're always going to come back and be slightly disappointed. And I thought this was the craziest idea. But after speaking to this big investor, and he told me, look at these assets from the lens of the founder, right? What's the total addressable market? How much capital are they going to need to get into market? Do they have, or what is their competition? What major problems are they going to solve? Are they sustainable over the long term? And a variety of other things. And so I went back and I started to do real diligence on Airbnb. And what I realized that owning your home in America is, quote unquote, the American dream. 85% of homeowners in America, possibly higher, rely on the capital markets to finance the purchase of their first home. Okay. And so I thought to myself, people are paying. Okay, it's the number one asset for most Americans is your home. Okay, most people are paying HOA. Most people are paying taxes. Most people are taking on a mortgage. Most people pay. Everyone pays insurance, right? You need a new couch. That's not covered by insurance. You're out upgrading your furniture, right? One of your electronics break. You've got to replace it. You have a leak in the roof, most likely not covered by insurance. So you're spending all of this money to maintain your number one asset, but you're not getting any cash flow on that asset. It almost seems as if that's a stupid investment, because the only time you'll see any return on that investment is if you sell your home, right? And most people don't live in Aspen, Colorado. Most people don't live on the shores of Miami Beach or in the Hamptons. They live in benign neighborhoods. And in those benign neighborhoods, people are relying on the macro picture, interest rates. If they sell their home, they're not getting equity jumps like they are in these big city, urban markets, right? And so where do people go? But if people can get cash flow on their biggest investment, Airbnb could be a great idea. And it turned out to be one of the best companies, best investments, I've ever made, and probably one of the best companies out there today. So that
Yeah.
really forced me to start looking at the world in a much different way from an investor, in my investor lens.
I love that. I love that. So the Seed Lab was consumer first, something Navy, Stoho, Terra, Cafe, Simulate. Synthesis is broader, right? Software, biotech, hardware. What forced the widening of the aperture?
Well, I did bring in two partners. I have a partner named David Melman, who's an incredibly smart guy, grew up in New York City, worked in the public markets as a portfolio manager for a multi-billion-dollar hedge fund. And he ran a single family office, running their venture / private equity sliver, for over 10 years. We brought in a younger partner, came from Princeton University, worked at Accenture for a bunch of years, and then just came from a different fund. We're a multi-generational lens. My youngest partner is 31, 32. My middle partner is 44, 45. And I'm a half a dozen years older than him. So we've got this multi-generational lens that enables us to really see the world in a much different way. As a collective, I don't really know what the 30-year-old community is looking at, right? He doesn't know what the 50-plus-year-old community is looking at. So having this multi-generational lens, I find to be incredibly insightful, incredibly helpful, right? But we all have our strengths, right? And we just have very, very core disciplines, right? And so I am more of the colorful founder of this fund, where I am spending an exorbitant amount of time with our founders, right? I like to profile them personally, professionally. From our personal lens, who are their role models? What lessons have they learned, right? Good, bad, and everything in between, right? Where do they come from, right? What's their past experiences? What were some of the biggest lessons they learned during that period, right? Are they creative, right? Can they maintain the creative culture, in startup world as an entrepreneur, right? And then professionally, are they frugal with capital, right? Are they disciplined, right? Are they communicative? Are they people that I want to introduce to my community, right? My community, if I don't have direct access to someone that can help one of my founders, I am probably a quarter to a half a degree of separation from finding that person. So we really, really like to work with our founders as an extension, right, of their executive suite, right? We like to help operationally. We like to help organizationally, but I also like to be a friend, with a hard stance to that founder, because any founder who's created their platform, who hasn't had the experience of running a company before, once you take on a fiduciary responsibility and you are managing outside capital, the world looks a lot different, right? So we are there to help and assist a lot of our founders, and that's what I do, and that's what I enjoy. You do not want me in a data room. That's my two partners' jobs, right? You simply do not. I am not qualified like they are, but I can find these assets. I can work with the founders. Again, I can help operationally, organizationally. A lot of founders in our community, they do not have the ability to hire and fire, right? And I think that that is this very, very, very special skill that I think is super critical for the success of a platform, right? Because as they say, one bad apple can spoil an entire bunch, right? People oversell themselves. Founder often find themselves somewhat, from a time management perspective, insecure that they are doing everything. They need help yesterday, and they go out and they find the wrong people, right, for the wrong price, and this could really be detrimental to the growth of that asset. So I really, really try to help our founders find the right people, the right personnel. I always am asking, what is the right message that you are sending to your staff? Are you maintaining that message? Are people signing up for that message? Are your senior partners signing up for that message? And because it's super critical that people work together as a team. And so I am there to sort of be a guardrail. I'm there to be a friend. I'm there to be sort of an introduction partner. I raise money for a lot of the companies that we invest in. And so we really become an extension of senior management for a lot of the companies that we work with.
Most VCs, they run from weird. You seem to be running towards it, near space tourism, de-extinction, premium fashion. Where did that instinct come from, and how much of it is maybe just New York?
Well, I want to find companies that are going to be the most talked about companies in the world, right? So Colossal Biosciences, I've spent the last 2 years working in and around Colossal Biosciences. The company is a de-extinction platform that not only is a preservation company, a conservation company, but now a full IP offering. They're working on national security. They are working on bringing animals back that have been eliminated from our planet for thousands of years. They're removing animals from the short list of extinction. And the commercial applications are massive, right? Theme parks and video games and bed sheets and water bottles. It's a fascinating company, but it checked every box. Here was a company that was doing stuff to save the planet, right? From a conservation perspective, preservation perspective, right? Now all the fun ingredients. The company brought back the dire wolf last year, which is the animal that's in the Game of Thrones. A preceding announcement, they introduced the woolly mouse, which is a hybrid of a woolly mammoth and a regular mouse, right? They worked on the moa, which is a flightless bird indigenous to New Zealand, which attracted Peter Jackson, the Lord of the Rings director, from becoming a big investor in the platform. Last week, the company announced the artificial womb, right? We birthed real chickens from a synthetic artificial womb that's producing DNA. So let's not look at face value. Let's look at what this company is doing to change the planet, right? Having an artificial womb will become the most disruptive thing in the world of fertility. Anyone with a viable egg and a healthy sperm will be able to have a child. That's unheard of, right? But in the interim, this is going to be the mechanism that's going to help rebirth these animals that are really good for our ecosystem, right? So I've raised a substantial amount of money for Colossal. I think that Colossal is doing some incredible things for the planet, more so for the people that live here, right? And I do believe, and if you're looking at this again, seeing this sort of playing the long ball, if the company continues to prove out the science, could this be the extension? Could this be the platform that provides or gives the extension for life? Who knows? And as we all know, that's a lot of where the investable capital is moving or rotating into now, right? I do believe, Sonny, you and I talked that, in the late 1990s, a lot of the money was going into technology. In the early 2000s, it was healthcare. Then it was biotech, right? Now we're sort of on this valuation chase of AI, and that's sort of changing the world, right? But all of the big money now is looking to invest in share platforms that are making the world more sustainable, providing elements of wellness with the possibility of life extension. So you're going to see a lot of messaging in and around that. We've already started to see it, and we're just going to continue to develop over the next coming years. And I do believe that Colossal is one of those businesses.
Yeah, I'm definitely looking forward to living forever. That's on the list. So Synthesis Ventures, right? 3 founding partners, seed checks from 500K to 2 million, software led with optional consumer and hardware, right? So in a market full of, $4 billion mega funds, what's kind of the unfair advantage of staying small and early?
Well, look, a lot of people are because of access to the private markets, unlike access that people have ever had before. There's a lot of valuation chasing going on, right? We've got the capital markets have been closed for the last several years, right? We've seen some decent IPOs over the last 6 months. We have a couple of the biggest IPOs in the history of the public markets coming this year. And so people want access, right? But people also, because of access to information, access to technology, people are making a bit more of a discernible choice for themselves. And when they put themselves in in a fund structure, right? Very, very difficult for people to sort of be discerning, right? So if you're in a pledge fund, you can pick and choose what investments you want to invest in. If you're in a blind pool, right, you're at the mercy of your managers to invest in whatever they want to invest in. So I think there will be some rotation, but right now I think people are looking for these opportunities that they are seeing and that they are reading about on a daily basis. And so again, back to our first sort of comment on today's podcast was, let's get from A to B in the path of least resistance by showing people opportunities to invest in the Airbnbs of the world, in the Colossals of the world, in the Pathwaters of the world, all companies I'm involved in, right? As these companies are continuing to grow, now these people understand the kind of quality that you are bringing to them as a direct investment. Let's now bring them a blind pool fund because you have now demonstrated that you are bringing some of the best, most interesting deals out there, that they will have access to. I hope that makes sense, Sonny.
Yeah, it definitely does. You brought up AI. I mean, people say AI is essentially eating early stage. I mean, every deck now is now AI flavored. How has that changed, kind of like how you do diligence, and what's the new red flag?
Well, if you remember back in the 2000s when you had companies and they would just slap a .com, onto their title, these companies that were penniless on public markets, all of a sudden with that .com, these things were trading through the roof, right? Um, Look, AI is real, and AI is changing the world, and it's changing the world rapidly. And I always go back to what we talked about earlier, when my father first came home with a Sony Walkman, and I was able to walk around the confines of my own private space listening to music. It was 6 months thereafter he came home with the answering machine, right? Then it was 6 months later he came home with some iteration of a Betamax or a VHS where we were able to watch home movies. Then he came home with a microwave where you're able to heat your food in 30 seconds or less. So these were major technological, achievements, but they were spaced out over time, giving us enough time to enjoy, appreciate, these advancements that were making our life a lot easier. Now with AI, things are moving so quickly that it's very, very, very challenging for anybody to keep up. What's super critical today? How do we know it's not obsolete tomorrow? How do we know that something won't usurp that technology a couple months from now? Right? So it's very, very, very challenging. So we'll look at top of the funnel, we'll look at bottom of the funnel. And let me just sort of give you an example. Let me sort of humanize this. Let me make it easier to understand. We're not in healthcare. We're not in biotech. So, but let's look at Ozempic. Everyone, GLPs are here to stay. It's helpful for people suffering from various forms of diabetes. It's obviously, a weight loss drug, right? Um, how do you get the GLP into your bloodstream? Through a syringe, possibly an ingestible, right? A lot of people who are taking these GLPs are suffering from significant side effects, right? What is the bottom of that funnel? What are people taking to alleviate some of those effects? Whether it's a supplement, whether it's a cream, right? So we'll look at top of the funnel, bottom of the funnel, because maybe we miss middle of the funnel, or maybe middle of the funnel is not really part of our core thesis, but we want to become part of a category that's here to stay, that's changing the world. So AI, it is here. But let's look at top of the funnel. Let's look at bottom of the funnel. Let's look at companies that, with an integration of new upgraded technology, with the integration and introduction of AI, can we get those industries back into the mainstream? That's what we would look for.
Super cool. I guess help me land the plane, Jesse. This has been fascinating and super informative. 10 years out, right? What does Synthesis's portfolio look like? And what's the headline you actually want? Like the one that has nothing to do with valuation.
What does it look like? I really would love to have a portfolio of companies that, you know, at one point may have seemed like they were a fad, but they became a trend. They became a sustainable business. They became a brand that is here to stay. I really truly want to be involved in companies that are, again, changing the world, that are making the world a healthier and happier place for people like you and I and our children, right? That would make me feel really, really, really good about the work that we've done. And yes, of course, sometimes we're conflicted because we see really great opportunities to make money, but they may not fit in that category. So where's the sacrifice? There's definitely a balance, right? We do have a fiduciary responsibility to our investors. We need to make money in order to live, but because we could be a bit more discerning, we gravitate towards assets, that are doing just that, that are making this world a happier and healthier place for people like you and I and our kids.
I love that, Jesse. That's touching, and the fact that you've kind of married profitability with doing good is really inspiring. Jesse, where do people learn more about, I guess, your fund, but also yourself? Are you blogging anywhere? Are you on LinkedIn? Where do you share your
No,
thoughts?
look, this is Sunny. This is all very new to me. I did a podcast maybe a year ago.
Hmm.
And apparently the podcast was well received. And I've been, a guest on many of podcasts. I don't have my own. People could certainly find me on LinkedIn. I respond to just about everyone who contacts me on LinkedIn. And hopefully I'll be a guest back on your show, sometime in the near future.
Yeah, I just got through a fraction of the questions I had for you. This has been a lot of fun, Jesse. I learned a lot. And wow, we've got over 30 people listening live. Thank you all for tuning in. I appreciate it. And until next time, we'll bring this one to a close. Jesse, hang back for maybe 1 minute.
Thank you, Sonny. Thanks for having me.